What is going on, guys? So it seems that the Fed is terrified of a recession. Now, I have some evidence for this. This is not something that I just came up with. I will show you the evidence in a second. But it seems that they're terrified of a recession. And the way that they talk in FOMC meetings and at Jackson Hole doesn't really paint the full picture of what is going on behind the scenes at the Fed. So let me share this with you real quick, and then we'll get into it. I'm also curious to know what you guys think, so leave it in the comment section below. Actually, it's too damn windy out here. I'm going to go inside. Let's finish this inside. All right, much better. So let me get into this bombshell news here, this bombshell report. This was actually released by the Fed. However, it was released quietly. And what is said in this document, in this paper here, is very different from what Jerome Powell says in FOMC meetings and what Jerome Powell has said at Jackson Hole. And this is why I think the Fed is actually going to pause in September. They meet September 20th. And remember that we have CPI on September 13th. I did a video on why I think CPI has a chance of coming in higher, but I do think they will pause according to this. So let's get into this real quick. Now, this was a paper released by the Federal Reserve Bank of Chicago last week. It's called Past and Future Effects of the Recent Monetary Policy Tightening. And it basically talks about how effective have the rate hikes and the monetary policy at large, which are supposed to include balance sheet reductions, although we haven't seen much of that. But it's supposed to tell us how have the rate hikes been working? How have they affected the economy? Are they working as they should? Are they working fast enough? Too slow, etc. So here's what they say. It says, we estimate how much of the impact from the Fed's current tightening cycle is yet to be felt in the U.S. economy in both absolute and relative terms. Here's where the bombshell starts. We estimate that although the majority of the effects on output and inflation have already occurred, the policy tightening that has already been implemented will exert further restraint in the quarters ahead, amounting to downward pressure of about 3 percentage points on the level of real gross domestic product, GDP, and 2.5% points on the consumer price index level, which is CPI. It says tightening effects on the labor market manifest more slowly, so more than half the policy impact on total hours worked is yet to come, meaning there will be more bad news on the horizon as it relates to unemployment. Bad news, obviously, for the employees, but good news for the Fed because this is actually what they want. But of course, they don't want to be blamed for a recession. So here is further reading on this. Here's what they say about a recession. According to the model's forecast, the policy tightening that's already been done is sufficient to bring inflation back near the Fed's target by the middle of 2024 while avoiding a recession. When have you heard Jerome Powell say this? Not at Jackson Hole, not in FOMC meetings. When have you heard Fed members say this? And here it goes on to say, some participants have signaled that the current tightening cycle might be nearing its end. And in short, this is where they conclude that there will be more downward pressure without any further rate hikes. About 3 percentage points on real GDP over the next 5 quarters, 2.5 percentage points on CPI. So it looks like they are already projecting a recession in my view, and it looks like they're already, at least internally, setting the stage for a pause in September. Now, what does that mean for the economy? What does that mean for the stock market? Are we going to hit a recession? Is the stock market going to crash? I promise I'm going to go over that in a second. Now, it's also funny to see that GDP growth as well as employment numbers appear to be revised lower. So you can see here, U.S. job growth wasn't quite as strong as it appeared last year after government revision. So they revised down the jobs numbers by 306,000. Also, we see here GDP is also revised lower. So not a coincidence in my view that we are starting to see signs that experts, economists, the Fed itself are actually gearing up for a recession in my view. Now, I don't think it's going to happen this year. I think that they are all looking for a recession in 2024. However, we did get some interesting comments from Waller last week, who is a Fed member. He said, although he anticipates a soft landing, a black swan can basically happen whenever. Let's hear what he has to say.
Is all of this in line with an outlook that you have for a soft landing, or do you still see a threat of a recession to the U.S. economy?
Well, the way the data is coming in, it's looking pretty good. But recessions often are caused by shocks that just come out of nowhere and hit the economy. So that can always happen, and that's why they're shocks. We can't really predict them. But the way the data is coming in right now, it's looking pretty good that if we can keep inflation coming down for the next few months, on trend at like 0.2 a month. We're in pretty good condition.
So if you take a look at the unemployment numbers, I mean, obviously the Fed is saying that things look good because unemployment is the one thing that hasn't really gone berserk during all of this tightening, but that rarely happens. If you look at the 2008 recession, unemployment was actually dropping, very similar to now. If you go back and look at 2000, unemployment was also at an all-time low, or a decades low back then. Same thing in 1990, same thing in 1980. You get the picture. So unemployment right now is actually, the unemployment curve is where it's supposed to be before a recession. And then obviously, you guys have probably heard this time and time again, but the bond market is absolutely broken. Here's the yield curve between the 10-year and the 2-year. And this is the lowest that it's ever been since 1980, 1981, around that time. And this also is, once this starts to flatten, then we are closer to a recession, as you see here, again, back in 2008, back in 2001. The yield curve has always been inverted, and then once it starts to flatten, then we get those that recession, because the bond market can't be broken for very long. I'm not going to get into it in this video in great detail. I have in previous videos, but the bond market can't be broken for very long. The treasury market is really the backbone of the U.S. economy, and really the backbone of the U.S. government and how they fund their government spending. So if the bond market, the treasury market is broken, then that tends to, and everything in the U.S. economy is based on the treasuries, right? So when you buy a house, when you buy a car, those percentages, those loan percentages are based on what treasuries are doing. So when treasuries are broken, then those different financial instruments in our economy that are based on those treasuries also are now under threat, because they're acting in a very irregular fashion and putting pressure on employees, employers, businesses, corporations, etc. And it's important to note with this thing about a soft landing. Soft landings have been predicted in every single recession of my lifetime. We've heard soft landing narrative in 1990. We've heard it in 2000. We've heard it in 2007. This is something that really has been going on time and time again, and we are hearing soft landing now. Now, one could argue that the bank failures that we saw earlier in the year, I think March, April timeframe, that was going to be our black swan if the Fed hadn't come in and yet provided liquidity in the form of an emergency loan program. You can make that argument, or you can make an argument that, hey, shit has yet to hit the fan. We have housing now at an all-time low. And I tweeted this out, by the way, so make sure you follow me on Twitter and Instagram for free daily and trading finance content. You might even make some money. I do release a lot of trade ideas and analysis on there as well. But mortgage applications to buy a house are at an all-time low, according to this chart here, this graph here, by Reventure Consulting. So, there are many parts of the system that can be affected, and we could see a black swan event. As a matter of fact, I'm of the belief that a credit event, some sort of black swan, is what's going to put us into a recession eventually, maybe in 2024. But now, speaking of the stock market, here's why I think that the stock market can still hit an all-time high. So remember that the stock market and the economy are not necessarily tied at the hip. They can be related at times, but the stock market can go on to advance much sooner than the economy is fixed, right? And so we are actually only about 7 or 8% away from all-time highs now. But if you take a look at every single major crash in history, so even in 2008, we hit an all-time high before we crashed. If you look at 2001, we hit an all-time high before we crashed. If you look at 1987, before Black Monday, the market was at an all-time high in 1987. So, I do think that before a recession, being only 7% away, and the fact that we are in a new bull market, I do believe that we can hit an all-time high. And who knows, a recession could be a year from now, right? We could be talking in September 2024, and a recession has not yet happened. So I do think a recession is coming. I don't think, unless we get some sort of black swan event really soon, which is something that we can't plan for. So, I mean, it's a moot point anyway. But I do think that the market is going to hit an all-time high first, likely during this year in 2023. As I said before, August and September will tend to be slow months, and I expected that, which is why we maintained our shorts and why we are up almost 70% on our SPY short. And if the Fed pauses, as the data that I showed you indicates, unless September 13th, which is the CPI, we get a bombshell CPI report and CPI is over 4%, which is possible. Maybe not plausible, but is possible. Unless inflation comes in crazy, I do think the Fed is going to pause on September 20th, and that will yet give the impetus. I mean, if we're only 7% away and the market pause and the Fed pauses, don't you think that it's very plausible that we grow 7% between now and the end of the year? And if you look at the FOMC watch tool, 92% of traders are betting that the Fed funds futures or betting that the Fed funds itself remains unchanged, meaning that the Fed is actually going to pause, or as we call it, skip, in September, and maybe consider a rate hike on November 1st, which is the next meeting after September 20th. So we'll see, but it is possible that inflation does come in higher than expected. Again, I tweeted this out, but if you see August CPI is now projected to be 3.82%, September CPI is now projected to be 3.91%. We had ISM, which is related to services inflation, coming in much higher than expected. So after inflation bottomed out at 3%, we are now seeing expectations nearing 4%. So it depends. If September CPI comes in near 4%, then yeah, the Fed is likely going, their hand is likely going to be forced. Otherwise, I do think that they pause. Now, like I said, we're up almost 70% on our SPY shorts. We also open up cash secure puts on Tesla, which are up already, up 20% already. You guys always ask me for cash secure put ideas, and I release them constantly in the Trading Academy, along with our shorts, our analysis, etc., as well as our day trade alerts. We don't care which direction the market opens on most days because we will go long or short depending on what we see. And we are relaunching our Mastermind 2.0. It's going to be 4 weeks, 8 classes, 2 a week, where we go over trading, technical analysis, options, and futures. We'll teach you how to trade A to Z. This is a live class that's actually taught by me. We are relaunching this on October 3rd. If you want to be put on the wait list, make sure you click the link in the description. Once waitlist spots are gone, they are gone. So you definitely want to be part of this live training that I teach personally. If you've ever wanted to trade futures, if you ever were confused about options, if you don't know anything about option selling strategies, how to generate a side income from option selling, if you wanted an explanation, a live explanation of my strategy, and you want me to explain it to you from A to Z in live, where you get to ask me questions about it, and I give you my exact strategy, how I trade. It's not the only strategy, but it's the way that I've been doing things. Make sure that you sign up and put your name on the wait list. Let me know in the comment section, what do you think about the Fed? Do you think they're going to pause? Do you think they are going to actually raise again? Do you think that they're terrified of a recession? Do you think a recession will come? Do you think we're in a bull market? Do you think we're not in a bull market? What are you doing with your stocks? I love to hear from you. Leave it in the comment section below. If you got anything out of this video, give it a big fat thumbs up. Subscribe to the channel. Hit that notification bell. Stay safe out there, traders. Peace.